You won't believe how investors have turned just 100 into 1,000 with one simple investing trick. And no, it's not day trading. It's not some sketchy penny stock gamble. And it's definitely not about throwing money into a meme stock and hoping for the best. This is a legitimate strategy that professional investors use, but most people completely overlook it. Stick with me until the end, because I'm breaking it all down step by step so you can understand how it works. Here's the deal. Most people think the only way to make big money in the stock market is to invest in massive, well-known companies. Apple, Amazon, Tesla. Sure, they're great, but the real money isn't made by buying these giants. It's made by finding the next Apple or Amazon before they explode. And that's exactly what savvy investors focus on. Many successful investors have identified something called small-cap growth stocks, specifically ones with strong revenue growth but low market caps. In simple terms, these are companies that are still small but are growing insanely fast. They're undervalued, but they have the potential to skyrocket. There are real examples of companies that fit this exact profile. Some had market caps under 500 million, but were growing revenue at a rapid pace. These stocks had been slowly building momentum, but no one was talking about them. By running them through key momentum indicators, a trick that will be explained later, investors saw the potential and took the plunge. And within a few months, those investments turned small amounts into substantial gains. It wasn't magic and it wasn't luck. It was all about understanding the right indicators and knowing when to jump in. Now, before explaining exactly how this works, let's talk about why this strategy is effective. Small-cap stocks are often ignored by big institutional investors. They're too small for hedge funds to care about, which means they don't get the same attention as larger stocks. But that's where the opportunity lies. When a company is fundamentally strong but still flying under the radar, early investors can get in before the masses do. Once bigger investors start noticing, the stock price can skyrocket. But here's the thing. You can't just buy any random small-cap stock and hope for the best. You need to know what to look for. And that's where momentum indicators come in. These indicators help investors spot stocks that are about to take off. One of the most commonly used ones is the Relative Strength Index, RSI. When a stock is trending upwards but isn't yet overbought, it's often a sign that more gains are coming. Another key indicator? Volume spikes. When a small-cap stock suddenly starts trading with higher volume, it means big money is moving in. That's a signal worth paying attention to. This might sound a little technical, but don't worry. The breakdown of how to find these stocks is coming up. But before that, let's talk about risk. Because let's be real, this isn't a guaranteed strategy where every stock picked turns into gold. There is risk involved. Small-cap stocks can be more volatile than large-cap stocks. That's why it's crucial to do thorough research, manage risk, and never invest money that can't be afforded to lose. And of course, for those who are ever unsure, consulting a financial advisor is always a good idea. Now, let's get into the specific steps to identify these stocks. First, screening for small-cap stocks with high revenue growth is essential. There are free stock screeners online where companies can be filtered by market cap and revenue growth. A common strategy is looking for companies with at least 20% year-over-year revenue growth, but a market cap under $1 billion. Next, checking recent stock performance is key. Has the stock been trending upward? Is there a steady increase in trading volume? This is where momentum indicators come into play. RSI can be used to see if the stock is gaining strength without being overbought. A good range is between 40-60 for room to grow. Also, watching for sudden volume spikes can indicate institutional buying. Finally, and this is the most important part, being patient but ready to act. Once a stock is found that fits these criteria, waiting for the right entry point is essential. Many investors enter when a stock is consolidating but shows signs of an upward breakout. This gives the best chance to ride the wave as more investors jump in. Another key aspect to consider is diversification. No matter how promising a small-cap stock looks, seasoned investors never put all their money into one stock. Spreading investments across multiple high-growth small-cap stocks reduces risk and increases the likelihood of hitting a major winner. This strategy ensures that even if one investment underperforms, others may compensate and deliver strong returns. Moreover, keeping an eye on market trends is crucial. Certain industries, such as technology and biotech, have consistently produced high-growth small-cap stocks. By staying informed about industry trends and technological advancements, investors can identify emerging opportunities before they become mainstream. And there you have it. That's the exact trick many investors have used to turn 100 into 1,000. If you found this valuable, Make sure to like this video and subscribe for more investing tips. And if you're serious about growing your money, stick around because more strategies are coming your way. Drop a comment if you have any questions. Responses will be made to as many as possible. See you in the next one.